Hello dear algorithms traders, today's post is about the three biggest enemies in trading: fear, revenge and greed. The word evil is interpreted as malicious, nasty, mean, ugly, vile, or shameful. And the crucial question remains whether fear, revenge and greed are also part of it. Are these three characteristics actually our greatest enemies, or is this just a way for the trading coaches to instill their unnecessary mindset in us? In today's post, I'll show you a simple way to kill the three houseflies of fear, revenge, and greed in one fell swoop. First, let's talk about fear. Fear is something completely normal. Along with joy, disgust, anger, surprise, sadness, and contempt, it is one of the 7 basic emotions. Fear is necessary for survival because it serves as an alarm system and warns our body of danger. For example, anyone who stands close to the abyss usually becomes afraid. The feeling conveys the message: be careful, danger lurks here. The amygdala sends a signal to the adrenal glands to release stress hormones, adrenaline, and cortisol. The liver produces sugar. Breathing becomes shallower, adrenaline accelerates the heartbeat and floods the muscles with blood. Fear makes our bodies and minds more alert, which allows people to exhibit the so-called fight, flight, or freeze response. Fear is deeply rooted in our evolutionary history. It dates back to a time when people fled from or attacked wild animals to ensure their survival. Fear can even be fun, it's the icing on the cake. Many people use fear as a thrill. People experience joy in fear, but with certainty that the situation will end well. In trading, you are afraid of losing a lot of money. And that's not entirely unfounded, because there are different brokers and different laws. In addition, many traders have lost a few 100,000 euros in a black swan in the past. So being afraid is something completely normal, especially in trading. And that's always funny when we see the psychological contortions of the individual trading coaches in order to take away the participants' fear of the markets. There are all the recommendations: read a good book, believe in yourself, analyze your fears and work through your past. The fear of not being right is unfounded. Fears don't help you, you have to outsmart your psyche or keep a feeling diary. This shows once again that trading coaches don't have to be afraid of trading. Ultimately, the coaches receive a fixed salary from their students. Revenge trades usually occur after a losing trade where you cannot accept that you have just lost a lot of money. The bad thing is that this anger sometimes causes you to double or triple your position in order to recoup your loss as quickly as possible. And now the vicious circle begins. Because if this goes well a few times, you will use this strategy again and again, until the point where it really hits the fan, and you lose a lot of money. But the trading coaches have a solution here too. They teach you, you have to accept your losses. The trading coach demonstrated this in an exemplary manner because he stopped trading and now prefers to conduct training courses. You need a clear strategy and firm rules. However, you won't learn this from the trading coach because he has no idea. You will also not learn the topics of risk management and discipline from the trading coach because he cannot trade profitably himself. You get the recommendation not to allow emotions. This shows that he never acted himself. I think the recommendation to just go for a walk or stop trading that day is really great. I mean, you don't have much time to achieve your goals anyway, and then you should stop trading. The recommendation to reduce the position shows that he previously recommended you trade with higher positions. Checking your trades is a great idea, especially when the coach can't tell you how to do it. The absolute sharpest idea is not to go against the market. 90% of all traders lose money every day. How are you supposed to know in which direction the market is moving? If people knew this, 90% wouldn't lose. Yes, and then of course there is trading greed, which means that people take far too much risk and of course trade with far too much capital. And in fact, there are some traders who don't care at all. However, they also come to their senses when the money is gone. Of course, the trading coach has a solution here too. You can learn how to get greed under control in my coaching, seminar price 15,000 euros. I think that says it all. To become successful, I first need an external analysis and then an internal analysis. In our case, external means the opportunities and risks within the market. With a little expertise in strategic money management, I can oversee these risks. What I'm still missing now, however, are my personal strengths and weaknesses. Because if I don't know them, I won't be able to take advantage of the opportunities and risks of the market. That's why you only have to answer 2 questions first. Are you more of an introverted, inward-looking person or an extrovert, outward-looking person? Let's say you're more of an introvert, so let's draw that in here. The next question, do you make your decisions more rationally or emotionally? Let's assume that you make your decisions more emotionally than rationally, then we'll draw that in here accordingly. The result now looks like this, and in this case your main strengths lie in the area of the reflective trader. Of course, there are still strengths in the areas of synthetic, pragmatic, and experimental traders. The synthetic and reflective trader belongs to the group of fear traders, while the pragmatic and experimental trader belongs to the group of greed traders. The reflective and experimental trader is most at risk in the area of revenge trades, while the synthetic and pragmatic trader are more of the resignation traders. They are more likely to accept the losses but are at risk of giving up more quickly. Of course, the experimental and pragmatic trader loses the most money, but they are also the first to potentially make a breakthrough. Which colors are optimal for becoming a successful trader? The answer, well, all colors are equally good. First of all, most traders have different colors. In this case, the strongest color is red. This is the main potential. The second color is green and thus supports the main potential. The weakness here is in the yellow and blue areas. There are different evaluations. If you would like to know more about it, watch this video, where you can find out for yourself which colors support your trader existence using 10 questions. What might also be interesting is that my strengths in trading lie in the synthetic and experimental areas. And when it comes to communicating with people, I'm more of a pragmatic, reflective person. This means that there is no static system, but rather that every person has different strengths and weaknesses in different areas. However, he should know them in order to get the best chances. Let's look at an example that shows that a person can use different skills in different situations. Imagine you are meeting up with your friends to go karting. You have never driven a kart yourself and have no experience in this area. The uncertainty creates fear because you know if you drive too fast you could fly out of the corner. Accordingly, you should initially drive carefully. Now your friends overtake you in the curve and make fun of you for driving so slowly. Now thoughts of revenge come to your mind, and you want to prove to your friends that you can be faster. Exuberance sets in, you step on the gas, and you overtake your friends. In the curve you notice that the kart is drifting a little outwards and you start to feel afraid. You slow down a little again and all your friends overtake you again. You realize that your friends are simply better at karting than you, and from now on you let them drive ahead. This means that in different situations we are able to use different skills accordingly. How would you now be able to drive karts better than your friends? Well, if you had trained with the kart for a few thousand hours, you could easily outdo your friends and your fears would also disappear. When you start trading, with a CRV between 1 and 2, you can expect to achieve a win rate of 30% and a loss rate of 70%. The biggest challenge is to first limit losses in order to reach your break-even point. After that it's about profit, and then it's about making money. The most difficult hurdle is the break-even point. Making a profit is only half as difficult, and then earning a living is only a small step. To break even, you should complete at least 11,000 trades. In the beginning you will always lose more than you win. But over time, the profits become larger and the losses become smaller. Let's now calculate the overall result. After 11,000 trades, your average losses will be 60%. And if we calculate this for the futures and Forex market, you will lose 1,300 euros in Eurist and 70,000 euros in Euro 6E. If you had to choose now, where would you rather trade? To reach your break-even point as efficiently as possible, avoid doing the following things. The coaches recommend. You have to trade the S&P to become successful. Each of us knows that high volatility not only incurs high costs, but at the same time it also entails high risk, which automatically leads to faster loss. That means you lose 2.5 times faster in the S&P and 4 times faster in the stock market. We no longer need to discuss that you should trade in the futures market as a beginner, because I think the numbers speak for themselves. Of course, you pay a little more fee in scalping because the take profit is smaller than in day trading. However, in day trading you need at least 12 years before you can make a living from trading. As a minute scalper, it's much faster. We have also often spoken about the saying that volume trading is the most successful strategy. The coach tells you that you can see exactly what is currently being bought in the market, but that's a lot of nonsense, because in volume trading the market sell orders are added to the market buy orders. This means we add the dollar to the euro. What kind of sense does that make? In addition, the market sell orders have nothing to do with the market buy orders and never meet in the market. That alone must show everyone that volume trading is absolutely pointless. Especially since the big players don't work with such mountains of volume. And the idiotic statement of the footprint chart is also a guarantee of success. On the left we see the red market sell orders and, on the right, we see the blue market buy orders. These two types of orders have nothing to do with each other, and we know that market orders are usually triggered by retailer stops. The crucial orders in the market are the limit orders because the big players only enter and exit using them. Since this is usually done with synthetic iceberg orders, these orders cannot be identified in the market. Of course, market orders move the market, but limit orders determine where the market ends up going. What fear do you have to have as a trader? We have 2,000 euros in the account, although we can start with 500 euros. We trade with 0.01 lot and have a risk of 0.02%. The expected profit is minus 13 cents, the expected loss is minus 25 cents, and we lose 12 cents per trade. In total, that's 1,320 euros in the end. In the future market we have to deposit at least 21,000 euros to trade with 0.5 slot in the Euro FX6E. The risk is significantly higher, and the expected profit is negative 8 euros and 25 cents. The loss is minus 15 euros and 75 cents, and the total loss per trade is 7 euros and 50 cents. This results in a total loss of over 70,000 euros. Of course, you could increase the leverage through an American broker, but in the case of a black swan this would require additional payments. If we trade in Germany, the risk of a black swan in the futures market is 21,000 euros and in the Forex market it is 500 euros. By now it should be clear to everyone why there is no need to be afraid in the Forex market. This actually eliminates the greed because since we only have a profit rate of 30% at the beginning, we have to trade with the smallest unit in order to lose as little as possible in the end. Let's get to the revenge trades. Let's say out of 11,000 trades we do 1,000 revenge trades. These cost us 250 euros in the Forex market and 15,750 euros in the futures market. That's a significant difference. Of course, on the way to breaking even, you also need a clear evaluation in order to analyze and optimize the individual errors. Now some will say, well, then I don't have the important future data that gives me basic information. But that's not a problem either, because you can get future data at any time. Of course, also the appropriate technology and screens, because after all you save a lot of money in the Forex market. This enables you to work long-term as a hybrid trader in order to find clear reversal points using the Bionic Candle and of course to learn the approach of the big players. Fear, revenge, and greed have nothing to do with mindset and can be eliminated with many trade repetitions. Today I showed you that you don't have to invest a lot. I keep my fingers crossed for you and look forward to seeing you here again soon. Kind regards, Michael.